Hi, I've had a great question on risk aversion, particularly if you're older. Okay, so let me just summarize a few things on mitigating our risks in the markets. Remember, all investing is risky. It's not a bank account, and you're never guaranteed of getting your cash back. So let's look at this. This is from JP Morgan Asset Management. Okay, and that's where cash sits in terms of volatility. And why does cash have any volatility? Well, interest rates can go up or down. And you can see what the compound long-term return is annualized between 2004 and 2019. Happens to be in pounds. You could be anywhere in the world, okay? So I want you to be aware of that. Now, further up, you've got UK gilts. In other words, where you're lending money to the UK government. And the volatility is 6%. Compound return is around 6%, 1 to 1. The return to the volatility, okay, and normally things go 1 to 1. All right, they go on this nice little horizontal, this nice little diagonal line, and if they didn't, if there were an outlier where you got lots of return with no volatility, guess what? That's the holy grail. Doesn't happen. All right. That's what private investors think happens. High returns, low volatility. They don't even know what volatility is. Low risk. They think chances of you getting it very high, or they underestimate the risk and still think they're up here when they're not up here at all. So let's look at the next thing. Global investment grade bonds. That's usually issued by companies, such as, let's say, Amazon. It's investment grade. How do we know it's investment grade? Well, a ratings agency will say it's AAA rated. Emerging market debt, bit more volatility, bit better return. Why is it got better return? Well, it's higher risk. What do you mean by higher risk? High volatility. What does volatility mean? It means the probability you might miss that return in any given year. Then you've got global equities. Look at where we're meant to be. Global equities, yes. We're higher risk. We're worse than emerging market debt. So lending money to the government of Malaysia is safer than investing, all other things being equal, in global equities. Now you might turn around and say, hang on, I think emerging market debt is a bit riskier than investing in Amazon. Well, you're right. If you get the right portfolio, it might have bond-like returns. In other words, good compound returns and lower volatility. And then you've got global high-yield bonds. Another word for high-yield bonds, junk bonds. So be a bit careful with those. Anyway, where does the lower risk sit for us? Well, lower risk means lower volatility. So if you're older, you're going to have more in gilts. More in global investment grade bonds, whether corporate or governmental. All right. Put another way, the older you are, and therefore the fewer years you have in terms of outlook, the more conservative you're going to be. More conservative, the more fixed income you're going to have, and the fewer the equities. This is again from JP Morgan. Sorry, this is from Goldman Sachs. This is from Goldman Sachs Asset Management. All right. Usual caveats, all investing is risky, but I wanted to share some industry practice, which actually isn't bad. Some industry practice is rubbish, some isn't bad. And here, what we see is the amount of equities they suggest you ought to have compared to fixed income, and the tactical range, plus or minus. All right? Plus or minus 15%. Now, I think I've got 25 years to retirement, and I'm particularly risk-loving, so I'm going to put a whole 100% into equities and no fixed income. But the question then arises, well, that's all very well, Alpesh, but what fixed income is out there, and how should I buy things anyway? Okay, if I do want to buy equities. Well, one way to buy equities is to dollar cost average or pound cost average. What does that mean? That means you put an equal amount in. This is from Fidelity, the big, massive company Fidelity. Potential difference investing £3,000 as a lump sum tomorrow versus 12 installments of £250 for a year. Well, what happens and what their mathematics shows is because the markets don't just always go up in a straight line for all 12 months, they go up and down, up and down. Your average price per share will end up giving you, hopefully, a better average price. So even though there you see £4.43 because you pound cost average, as opposed to £5 if you just bought outright. Some people say too complicated, I'd rather just buy it and forget about it. But one way to mitigate risk, according to Fidelity, and they're right, pound cost average. Another way is to diversify. Well, we don't want to over diversify an infinite number of stocks or only have one stock. Too much risk if we have one, and there's no benefit in having lots and lots of stocks. So about 12 to 20, I tell people, is right. Okay, roughly, as long as they're not all highly correlated to each other. But let's go to fixed income. Again, talking about risk mitigation, where do we find things with in the field of fixed income which will allow us to mitigate our risk somewhat. So let me go to that. Let me go and explain that, move my fat face out of the way. Okay. And what I've done here is I've taken a bunch of exchange traded funds. I've looked at ones which have volatility under 10%, and you saw the volatility chart earlier. Sortino, in other words, their average performance and the volatility in relation to it, I've looked for at least a half on that. Ideally, I want above 1, but anyway, half will do. And return alpha means they're outperforming the broader market anyway. Now, that's less important for bond-related ETFs because they're not equities and we're comparing oranges with apples. But anyway, it's good to know what's outperforming. Hey, and there's a bunch of names here, and you can see there's 10-year Treasury Bulls, but that's 3 times leverage, but Treasury Bulls. Okay, the names usually are quite descriptive now. Of course, within there, you've got ultra 7 to 10-year Treasuries, okay, but you've also got zero coupon US Treasuries. So you can see the names, and it's easy then to research those afterwards. Now, of course, gone in there is physical gold and so on and so forth. We're here more to talk about bonds. And like I've said, government bonds, long-term government bond ETF, they tend to be a bit safer. Once you start leveraging, you're taking more risk, just so you know. Okay, we're not here to talk about gold. It's in there, but I'm not saying it's necessarily safer, though the statistics suggest it's right up there with government debt. There's even healthcare innovator ETFs, which are in there. But we're not here to talk about that. We're talking about government bonds, fixed income. Fixed income, remember the asset allocation? The asset allocation didn't say go out and buy some physical gold. It said government related. So you can see here where I've listed some of the volatility. Just take a shot of the image. You can see it there, and then it's easy enough. I'll let you into a secret. It's even easier. You go onto your broker's website, you put in ETF, okay, and government bond or US Treasury. These names will come up. And then when you do it, look at their performance. It'll give you a pretty good idea because if it's already got the word US Treasury or government bond, you'll be able to work out, actually, chances are its volatility on Sortino, even if you don't have these numbers like I do, are going to be pretty straightforward to get hold of, okay? The thing's going to be easy to get hold of. And anyway, look, there aren't many to choose from because after that, I've got things which are down over the last 3 months. I don't want anything that's down over the last 3 months. That's just personal taste. Because if I've got to narrow things down, then I might as well narrow it down on how it's also done over the last few months. So that should help you risk mitigate your portfolio.